Performing a break-even analysis is a critical step for businesses to determine the level of sales or production needed to cover all costs and achieve profitability. Here's how to perform break-even analysis effectively. Gather relevant data. Collect data on fixed costs, variable costs per unit, and selling price per unit. Fixed costs are expenses that remain constant regardless of the level of production or sales volume, e.g., rent, salaries, insurance. Variable costs are expenses that vary with the level of production or sales, e.g., raw materials, labor. Calculate contribution margin. Contribution margin is the difference between selling price per unit and variable cost per unit. Contribution margin equals selling price per unit, variable cost per unit. Determine break-even point in units. Break-even point, in units, is the level of sales at which total revenue equals total costs, resulting in zero profit or loss. Break-even point, in units, equals fixed costs, contribution margin per unit. Calculate break-even point in sales dollars. Break-even point, in sales dollars, is the total sales revenue needed to cover all costs and achieve break-even. Break-even point, in sales dollars, equals fixed costs, contribution margin ratio. Analyze break-even point. Evaluate the break-even point to assess the minimum level of sales or production required to cover costs. Compare the break-even point to actual sales or production levels to determine profitability thresholds. Sensitivity analysis. Conduct sensitivity analysis to assess the impact of changes in key variables, e.g., selling price, variable costs, fixed costs, on the break-even point. Identify factors that have the most significant impact on profitability and adjust assumptions accordingly. Graphical representation. Create a break-even chart or graph to visualize the relationship between sales volume, costs, and profitability. Plot fixed costs, variable costs, total costs, and total revenue on the graph to illustrate break-even point and profit/loss zones. Interpret results. Interpret the results of the break-even analysis to make informed decisions about pricing strategies, cost management, and sales targets. Determine whether current pricing and cost structures are sustainable and profitable in the long term. Use in decision-making. Use break-even analysis as a tool for decision-making, such as setting sales targets, determining pricing levels, evaluating investment opportunities, and assessing the feasibility of new projects or initiatives. Monitor and adjust. Continuously monitor actual performance against break-even projections and adjust assumptions as needed based on changing market conditions, cost structures, and business dynamics. Update break-even analysis periodically to reflect updated information and ensure alignment with business objectives. By performing break-even analysis, businesses can gain insights into their cost structure, pricing dynamics, and profitability thresholds, enabling them to make informed decisions and achieve financial sustainability.